Welcome to the PropLinq AI podcast, the show where we speak with founders and operators reimagining real estate through scale, systems, and smart technology. I'm Stuart Quintal, and after 10 years running at companies like REA Group and leading growth across the Middle East, I now run an AI agency helping property businesses optimize their lead flow and customer journeys. Joining me today is someone who's built a $230 million empire in one of the most underestimated corners of real estate, self-storage. Fernando Angelucci is the founder of SSSE.com and has scaled from flipping houses to owning over 54 self-storage facilities across 24 states in the US, while also developing and converting properties through ground-up builds and big box retail reuse. Now, we'll unpack how he made that leap and where the opportunity lies today and how he uses systems and tech to operate at scale. Fernando, awesome to have you on.
Thanks for having me, Stuart.
Now, you've built something pretty remarkable, but take us back, how did it all begin? And I guess what's the origin story behind your move into self-storage?
Yeah, so it started a long time ago. So when I was 16, I read a book called Rich Dad, Poor Dad. Kind of changed the way that I looked at making money and, how tax laws advantage people that do the things that the government wants. So I did go on to get my engineering degree, and then that was pretty short-lived. I think I only worked as a W-2 for about 13 months. And then immediately started going into real estate investing. So started off with flipping houses, doing contract assignments, very quickly built up a pretty good amount of cash, and then started buying rental properties, both housing and apartments. But very quickly, I realized that all my headaches were coming from the 3 T's. So it was tenants, toilets, and trash. So how can I get access to the advantages of real estate, primarily leverage and depreciation or accelerated depreciation, without having to deal with tenants, toilets, and trash? And so that's when I decided to make the jump from habitation-based real estate to self-storage. There's a slew of benefits moving to this new asset class. Very quickly, between 2016 and 2018, we sold off all of our apartment buildings. We had about 70 doors, and then bought our first self-storage facility in 2018. Very quickly ran out of my own money, so started bringing investors along for the ride. Now we're up to about 900 passive investors in our various deals and funds. To date, like you said, we've done 50. We just bought the land for our 54th facility. We're in 24 states, a little over $230 million worth of real estate.
Yeah. Now, if we look at, I guess that big number of 54 facilities and $230 million portfolio, what does that look from an operation perspective?
Yeah. So in the beginning, we had operations in-house. And what we realized pretty early on is that property management is somewhat of a loss leader unless you can do it at extreme scale. So, at a minimum, 50 REIT grade facilities, if not more, so that you're not actually losing money on the property management side of the business. So after our first, probably 12 to 16 deals that we self-managed, when we sold off that portfolio, paid back the investors, we decided to get rid of our in-house operations team and actually outsourced all of it. So now we use third-party operators. Usually they're, the names that most people in the United States that drive around see, Extra Space, CubeSmart, U-Haul, Public Storage, all the big names that do self-storage property management. They are our vendors.
Now, when we spoke earlier, you mentioned you got 4 business lines: acquisitions, ground-up development, retail conversions, and wholesaling. Can you break down how you allocate time and capital across those?
Yeah, absolutely. So, we like to run a pretty lean company. So I'm always trying to move fixed cost into variable cost, because then if something happens in the market, we have some, black swan event like COVID, we can move very quickly and be very nimble. So this all starts on the, the marketing side of the business. So not only marketing for self-storage properties and sellers, but also marketing for passive investors and limited partners. So that all comes from, started off with what we're doing right now. Start off with a long format podcast or conference interview, And then we use certain AI products that cut those things down into manageable bite-sized pieces that we can syndicate across all of the social media channels. Different channels have different types of media that they like. So, for example, TikTok is very short form content. Facebook and LinkedIn, a little bit longer form content. YouTube is usually like the main, the full thing, 45-minute, hour-long content that's not cut. And then we start using a bunch of products to, clean those up, put, subtitles on there, so that we're able to do all of that with a team, not only that is virtual, but then also that team has access to these AI tools that make their productivity go through the roof. So that's the first piece. Once we actually get the properties into our funnel, then it comes down to underwriting and making sure that we are, uncovering any challenge that may be presented by that deal, finding solutions to that. And once we close on the property, we on the management side, we use a couple different tools. So there is a tool that we use that encompasses AI as well, where it will do kind of three things. It will look at what our current customers are paying, and then based on how they pay and what their online social media profiles show about them, we'll rate them from a scale of 1 to 10 on how likely they are to absorb a rent increase. So, for example, the guy that pays in cash every month that is always a couple days late, maybe he just posted something on his online social media profiles that shows he's in the hospital. This guy's most likely not going to be able to absorb a rent increase. But then the guy that, has his payments on auto pay with a Amex Platinum card and his social media profile showing that he's gallivanting around, Europe, most likely he's going to score higher to a 10 and will be able to absorb a larger rent increase. So that's one of the things that the program does. It also will look at what our competitors are pricing based on their online rates, and will, as short of intervals of every 5 minutes, and will dynamically price our units to make sure that we're, if we want to be in front of them, if we want to be, at the same price, or maybe even offer somewhat of a discount to what they are offering to the market. And then it also will see when there is large search volume. So let's say for some reason, maybe there's a large event that's taking place in Chicago, and all of a sudden we see a spike in keyword search for self-storage in Chicago. The software will take that into account and actually raise the prices during those keyword spikes. So some super interesting stuff. So now to get back to the actual each of those legs of the stool there. So the first is going and buying mom and pop operated facilities. About 70% of all the self-storage stock in the United States is owned by these mom and pop operators. Typically, they're not using a pretty advanced tech stack, management technology to kind of help make sure that they're really being efficient with their NOI, making sure they're charging the highest rates they can, making sure that they're cutting down expenses as much as possible. So we'll buy those smaller facilities, we'll do the value add, we'll put them into larger portfolios of 10 to 15 properties, and then we'll sell those portfolios off to some of the larger players in the market. On the kind of opposite side of that spectrum, we have our ground up developments. So these are the deals where, we use software to identify land that is in markets that are underserved. See if we can get that land at a pretty reasonable price, maybe walking into some substantial equity, and then we'll build kind of these Class A, state of the art multi-story facilities. These things are $10 to $15 million to build. They have anywhere between 800 to 1,000 units. And then these things, usually we can double our return on investment on these within 3 to 5 years. And so those we sell off in one-off deals to, again, the kind of the top operators, the publicly traded REITs is kind of who we're shooting for to buy. And then we have that, adaptive reuse conversion strategy, which allows us to not only cut down on construction timelines, but also cut down on construction costs. And the way we're able to do that is by buying a shell that's already standing. So for example, finding a Sears building or a Walmart or a Kmart that is no longer operating, buying that at a very good basis, and then converting that into self-storage, especially because these types of big box stores are in really great areas for retail, and self-storage is considered a retail function. So we have customers, we want our customers to see us, We want to be by major thoroughfares that have a lot of traffic counts. We want to be by dense residential with people that have high median income so that they can spend that disposable income on buying stuff they don't need that they're going to put into our self-storage units, right? And then, of course, because we have such a large marketing engine, a lot of deals come to our desk that aren't right for us for whatever reason. They just don't hit all of our buy box criteria, but they may be a good deal for someone else. And so those deals will underwrite those. We will put them under contract and then assign our contractual rights to close on those assets to another buyer for a fee. And that allows us to, not only kind of cherry pick the best of the best that matches what we want and what our investors want, but still monetize leads that otherwise we would have thrown into the trash bin.
Now, going back a few years, I guess your first deal was around one acquiring retail conversions, talking some big money there. But I guess, what did you learn from that first deal?
Yeah, so I learned that every time you add a zero to a deal, it makes it easier to do, believe it or not. So the analogy I always tell people is when you're trying to go to a bank to get a $50,000 loan, it's like pulling teeth. Once you go for a $500,000 loan, it gets a little bit easier. Once you go to a $5 million loan, it gets even easier. And then once you get up to a $10 or a $15 million loan, then it becomes the easiest because they want to, to them, it's the same amount of manpower to underwrite a $50,000 deal and a $15 million. So why not make a larger fee on your, the points you have to pay to the lender? Same thing with raising capital. Let's say you have to try to raise $10,000, $50,000 in equity. You're talking to people that maybe don't have a lot of disposable income to invest those kind of small check sizes. As you start raising more money, $500,000, $5 million, $15 million, $25 million in equity, then you start talking to kind of professional investment firms where all they do is invest money in these passive investments. And they're sitting on a pile of cash. They know how to underwrite quickly. They are not gun shy. So if they see a deal that makes sense, they will invest quickly. So as you scale up your operations, scale up the size of the deal that you do, it becomes easier to transact on that deal. But then on the management side, it also makes it a lot easier. So, when you look at operating a facility, there's always kind of percentages that are allocated to do certain things. So, for example, if I'm going to hire a third-party manager, that third-party manager will usually charge me a percentage of the revenue that is collected, call it 4 to 6%. However, usually it doesn't make sense for them to get out of bed for at least a minimum amount. So what they'll say is, hey, we're going to charge you 5% of gross revenue or $5,000 a month, whichever is greater. And if you're operating a facility that only produces $10,000, a month in revenue, 50% of your cost is going to third-party property management. That doesn't really make sense. But if you're, operating a facility that brings in $50,000 a month in revenue or $150,000 a month in revenue, then that percentage of revenue drops substantially as a percentage. And then, there's certain functions that it's just the cost of the manpower. So for example, hiring someone to do all the maintenance, someone's not going to say, hey, I'll take 1% of your revenue to do maintenance. No, maintenance is maintenance, and there's an hourly rate that you have to pay. And if you don't have a lot of cash flow coming in a net dollar terms, you don't have the ability to hire somebody to do these things for you. And then now you're no longer doing an investment. You're basically creating a job for yourself, because if you buy a self-storage facility and then you have to sit behind the counter renting and cleaning and fixing broken things, that's not investing. That's just creating a job. So we learned on the back end as well that the larger the deals are, the easier it is, the more physical dollars you have to play with to hire superstar teams, superstar staff, to make sure that investment runs appropriately. And then it frees up my time to go find and do the things that I'm very good at, which is finding deals, raising equity, structuring debt, right?
Now, from what I've seen and what we've talked about as well, you built a pretty sizable business, but you've also designed the life as well, that might have been inspired by Rich Dad Poor Dad as well. Like more recently, you spent quite a bit of time in South America, and soon you'll be off overseas again. Like, how intentional has that lifestyle been?
Yeah, it's been super intentional. So what you realize is that when you are kind of stuck in one location and yet end up finding things to do. And what those things that you're doing typically are not the things that you should be doing as a business owner. You end up working inside of the business instead of working on the business. And that's a huge difference. So, for example, answering maintenance calls and things like that, that is not something a business owner should be doing. That is something that an employee should be doing. Whereas the business owner should be focusing on building the business, making it run more efficiently, and returning more value to the investors. So one of the things that we noticed is very quickly as we started traveling and our business has been 100% virtual. So everyone in our company, there's no main office building that everybody sits in. Everybody works from wherever they are. And so what we realize is you have to structure a business that is based on deliverables and not on hours worked. Because somebody can punch a clock and do nothing, but they were there for 8 hours, right? And that is not productivity. That is just punching a clock. So once you switch the way the metrics are measured for yourself, for your investors, for your employees to a deliverables based metric, then there is no hiding behind, well, I punched in, I was here that 8 hours. You have to get things done, and everything is based on these deliverables. How many calls did we make? How many dollars did we bring in? What did we bring in versus the weekly goal or scorecard that we have set up? So that has helped a ton. And then one of the things that I'm sure if you have a lot of business owners listening to this podcast is there's a lot of when you're working in an office, there's a lot of got a minute meetings. Someone knocks on the door, hey, you got a minute? And it's something usually your employee doesn't need you for. They need to go figure things out on their own. They need to have the autonomy to operate and add to the bottom line of the business. So you'll get a lot of those. And then even outside of the company, you have people that are potential, vendors, potential business people where they want to have a 3-hour lunch to try to accomplish everything that could have been done in a 15-minute email or even a text message. So there's a lot of people playing that they want to do business, but really they're just wasting time. You don't need to have this in-person meeting to figure out if a vendor is appropriate for your business. Send me an email, send me your track record, send me references. I don't need to sit with you for 3 hours and waste a bunch of time. So you end up becoming way more efficient when you physically are not present for people to waste your time like that. Right.
So I guess if everyone's virtual and remote, like what does the operating rhythm look like? Because then if no one's punching in on the time clock, I guess your time shifting, different days, different work people. What does that operating rhythm look like for you?
Yeah, we have people like across basically all time zones. We have as far as in the Philippines. So again, it's not something that we have built our standard operating procedures around deliverable based business as opposed to clocking in and having to talk to people live. There's no reason that you need to talk to me live. You can get everything, your point across or your questions across more efficiently in text as opposed to rambling on and on. So one of the things that we do is we start, I don't know if your listeners have read the book Traction by Gino Wickman. It is an absolutely fantastic book. It tells you exactly how to set up a deliverables based business and how to track those metrics. So start with a kind of like this far out plan. Let's say 10, where do you want to be in 10 years? Then you bring it down to 3 years, 1 year, and then 90-day goals, and then 1 week scorecards. And that all fill up, they filter up to get to that goal that you want to be in 10 years. So it's a very conscientious way of building business as opposed to just, let's see how this next year goes, right? You don't have any metrics. So once you get down to that 1 week scorecard, I know for example, my acquisition manager, he has to hit a certain amount of new sellers that he has to talk to every week. He needs to get a certain amount of contracts out for sellers every week. He needs to get a certain amount of contracts signed every week. And then you filter it down based on the steps. So there's no hiding. It doesn't matter what hours you work. Did you call 30 people or not? Did you send out 10 purchase contracts or not? It doesn't matter how many hours you're working. If you didn't hit your metrics, then there's a problem, and we either have to course correct or we'll free you up to pursue new opportunities outside of our company. So that's how a metrics driven business is run. So I don't care if you are doing a 9 to 5. I don't care if you're a night owl and you start working at 9 a.m. or 9 p.m. and you stop working at 4 a.m. As long as you hit your numbers, you can do it at any time that you want.
I can sort of relate to that, but from I guess looking at the metrics now, you sort of said 10 years, 5, 3, 1, down to 1 week, I guess, from operating perspective. Now, if we look at the next 12 to 24 months for your business, so I guess if you zoom out, what's next over the next 12 to 24 months?
Yeah, I could tell you exactly because it's literally structured. So in the next 24 months, we will raise an additional 25 million in equity. And based on the lending environment during that time, that will buy us, roughly 50 to $80 million of additional real estate. We have a couple assets that will be sold, a couple portfolios. So we're now on our third portfolio that we built up, and now it's time to kind of sell those, capture that equity, and return profits to investors. So that's kind of what we're focusing on. I think because of this new tax bill that was passed in the United States, there's a lot of opportunity for transactions on the real estate front, specifically because of something called 100% bonus depreciation. It allows me to accelerate the depreciation I would have taken over the life of the asset and take, a large percentage of that in the first year of operations. And what that allows you to do as an investor is shield other income that you have. So let's say you sold some investments, you made some capital gains, and now you're going to have to pay 20 to 30% taxes on that capital gains. You can shield those by investing into a deal that pushes a ton of bonus depreciation out. We have some deals where now with this 100% bonus calculation, for every dollar invested, you can offset anywhere between 70 to 90 cents in bonus depreciation against your taxes, be it K1 income or even W2 income if you qualify for certain specific metrics that allow you to be classified as a real estate professional. So this is going to drive a lot of, I think, trading, a lot of changing hands of property, so people can kind of reset that bonus depreciation. So I think we're set for a really good time. Self-storage has recently come out of a trough, if you will. COVID was a huge bump because people had to work from home and had to go to school from home. So they lost a bedroom or two. They had to put that on the storage. And then once the world war opened up again, all those people took those possessions out of storage and brought them back into their house. So that caused a little bit of a dip in our occupancies and our rent rates. But now we're starting to climb again out of that trough. So it's very good time to get into storage right now.
So you're still excited about self-storage, or is there any other broader real estate market that you're excited about?
Yeah, so I like to do self-storage because of certain things that it has benefits versus habitation-based real estate. So, for example, I don't have to deal with evictions. Everything is lien law. So if you don't pay me, I have a lien against your possessions, and then I can auction them off to pay back the rent that you did not pay me. There's also other benefits when it comes to the recession resilience of how self-storage operates. When times are good, people are buying a lot of stuff that they don't need. They're putting them in storage. When times are bad, people are downsizing typically, maybe moving in with friends and family, maybe having to get a new job that makes sense, so moving across state lines, and they're going to use self-storage. We are kind of in the transition business, if you will. So it's one of those things where anything that kind of follows those same trends I'm looking at. So self-storage is the main asset class. Now we're looking at contractor storage, so a little bit larger units for people that run a small business, like tradesmen or your import exporter or drop shipper, things like that. Follows all the same trends, follows all the same protections that I have for my investors. Something that we're looking at right now that I'm not sure if we're going to go into or not ourselves, but we may partner with other people, is to get better deals on our land packages. We have been buying larger and larger parcels. So I only really need 6 to 8 acres to build a pretty substantial size self-storage facility. But now I find myself buying these parcels that are 20 acres or 26 acres. So what do I do with that additional space that I don't need? What I can do is I can take the piece that I need to do my self-storage operations, and then I can get the remaining land and exchange that for equity in someone that does a different asset class that may be accretive to self-storage. So maybe a multifamily operator. I don't want to operate it, but I'm willing to give land that basically I wasn't going to do anything with anyway to you, and you give me a percentage of your business to build that out. Or, for example, extended stay. So let's say you have, you're currently in between housing. for whatever reason. Maybe you're moving to a new area. Maybe there was a change in your life situation. Maybe you got a divorce, etc., and somebody needs to move out of the house. You have these extended stay hotels that people stay at for 30, 60, 90 days. Same thing with construction. So anytime I do construction in different markets, there's usually a couple nationwide GCs that follow me around, and they will put up their project managers and their supers in these extended stay hotels for the duration of the construction project, which can be anywhere between 9 to 12 months. So they're not going out and renting an apartment. They'd rather just have one of these long-term stay hotels. And that is a similar demographic that follows, and similar investment thesis that follows self-storage.
What about like RV storage and boat storage, trailer storage as well? Like, is that
Yeah, so that falls under our self-storage purview, if you will. So that's included when I say that. Certain times there's what we build has a mix of all of that. It's mostly like the actual metal lockers that you store your things in, but then we'll have space for boats and RVs and cars. So it just depends on the market. Obviously, if you're in a market where the local homeowners associations don't allow you to park, boats and RVs on your driveway, or if you're in a market that has a large lake, like near Charlotte or near Lake of the Ozarks, obviously a lot of people are going to have boats in that area, and they're going to need a place to store it when they're not using it. So yeah, that is one of our investment theses.
Now, I guess like another thing, you're in the States. Have you ever looked at international expansion or other sorts of platform tech?
Yeah, yes and no. So the interesting thing about Americans is that they're extremely consumeristic. They buy more stuff than literally any other country. And it's always kind of stuff that they don't really need. So the metric right now is 1 in 9 people in the United States use self-storage. You go to some of these emerging markets, and it may seem like they're starting to catch the self-storage bug, but their use rates are sometimes 10x or 10x less than that. So 1 in every 110 people or 150 people use self-storage. So we are starting to see some international markets. Canada obviously is the most similar as far as the demographics to the United States, as far as consumption and use. You're starting to see things in some of these larger international cities like London, Singapore, Rio in Brazil, Mexico City, some spots in Australia, Sydney, etc. Anywhere where their housing prices are starting to increase exponentially. And so for the same amount of money, you get a smaller and smaller and smaller house because of the affordability issues. And that usually pushes people into start using self-storage almost as like an external closet, or, as an extension of their home.
Now, if you could solve, I guess, one challenge instantly, whether it's tech, capital, operations, what would it be?
It's a great question. So as a business owner, you're always trying to find problems to solve, right? So, our growth is fueled by passive investors. So people that they don't have the time to invest in self-storage themselves as an operator, but they want exposure to that asset class. So they come in and invest with us. The problem recently that I've seen is that, which has always been a problem, is there's a lot of these operators out there, not necessarily in self-storage, but just in passive investments in general, that are, not the greatest of people. And then things like fraud happen. You have SEC violations, and that causes a loss of confidence in sponsors and in syndicators as a whole. Even if you had nothing to do with that, it's not even in your asset class. I had a call the other day with someone that was potentially thinking about, investing with us. And he said, well, I invested in some oil and gas scheme like 10 years ago. Turns out the guy was like a Bernie Madoff style, fraud pyramid schemer. And that's why I will never invest in these types of structures where, there's a sponsor that does this. And I said, that's unfortunate. I have never had any bad streaks on my name. You can check with the SEC. You can check with all of my previous investors, great track record. But because you got burned by somebody else 10 years ago that was a fraudster, you said now carte blanche for the rest of my life, I'll never invest in these types of products, which is unfortunate because now he's missing out on, some pretty substantial returns versus, let's say, investing in public equities like the stock market. in syndications, it's pretty typical for people to have internal rates of return that are double or triple of what the stock market offers. Look at now, the US stock market is one of the most overheated it's ever been. You invest into a company that's got a 40 PE, which means it's going to take you 40 years just to get your initial investment back. That's wild, when in alternative assets, including in real estate, you can usually get your initial investment back in 3 to 5 years, right? So you're leaving a lot of money on the table by not having just a small allocation in your portfolio towards alternative assets. So I wish there was, and it's funny that I'm saying this, I wish there was more strict regulation around people that are allowed to raise money. I wish there was some type of certification or licensing that was required for somebody to raise money from passive investors. But unfortunately, it is still somewhat kind of the Wild West. It's a lot better than it was, from the Great Depression days. But there's still definitely a lot of room where regulation could come in and really protect these investors from people that are not honest and are out here to make a quick buck by defrauding others.
Yeah. Well, Fernando, look, this has been like a masterclass on how to scale with intention. Like, I'm very upbeat about self-storage, like especially the dynamic pricing, and I don't think people would be too happy to know that their social credit is being used for price increases, but also at the same time you might also protect them from a price increase. So now, look, where can people find out more about exploring opportunities with you? Where should they go?
Yeah, so I always tell people there's kind of two ways to reach out to me. If you're a more direct outreach type of person, you can call me on my cell phone. My number is +1 630 408 8090. If you're more of a kind of passive outreach person, you can go to our website, which is SSSE.com. So 3 S's, 1 E.com. And there's ways that you can, on our website, see our entire track record, where all of our assets were located in the United States. You can invest there. You can buy from us there. You can schedule a call to talk to me or any of my team members. It's all on that website.
Now, if you're listening and trying to scale a real estate business with fewer headaches and more leverage, this is probably for founders and operators coming up. So hit follow and check out their past episode on our podcast. Fernando, thanks again. Safe travels, and I'll be watching for the next 10x.
Thanks. It was good talking to you, Stuart.